We place more than 50 to 80,000 orders a day, and we execute about 20 to 30,000 of those as trades. So you can understand that there is no way that you can use any insider trading information in a quantitative, actively traded hedge fund like ours. In a space like ours, the more important effects are those of cybercrime. Increasingly, the world will need to pay more attention to cybercrime type issues around the investment industry.
You run a global quant fund. How does yours work? How is yours different?
We develop a theory, and then we create models to test that theory. Then we actually test it in the marketplace, and then we see whether it fits with the rest of the investment process before we implement it.
We know you're growing your asset base. No small task in an environment such as this one. It's pretty difficult to raise money. Why are investors considering quant funds? Why is it important for them to have part of their holdings in a quant fund?
There is global growth of hedge fund assets, and that is happening for a number of reasons. Number one is the Dodd-Frank Act in the US that is actually taking away proprietary trading from the banks and putting it out to private equity firms and hedge funds. The second reason is that the good performance of the hedge fund industry versus the traditional asset classes, as measured by volatility, by absolute performance, and also by drawdown control, has meant that hedge funds are attractive to investors now. And also institutional investors and sovereign wealth funds and general investors are finding that there is transparency in hedge funds, and they're increasing the proportional allocation to hedge funds.
Do you see demand for quant funds in general stronger or weaker post-credit crisis?
There is more understanding and acceptance of quant funds in the institutional investor space, and I think that quant funds, particularly ones with a very long track record and tremendous transparency like ours, coupled with the liquidity that we offer, give people exactly the product profile they need.
How do you manage risk? How do you prepare for a rare but potentially damaging event?
You have to prepare well in advance, and that means that risk management is part of your portfolio construction process, and that means that you diversify the asset classes that you are trading. You also diversify the time frames and the different models that you're using in order to generate alpha. So risk management is not something that you apply only outside the portfolio. The most important risk management processes take place inside the portfolio construction process, which happens every minute of every day. And we learn through every one of these massive events that have taken place over the last 20 years, and I have experienced at least 4 of them in that time.